You know that global power comes from missiles and military strength, or maybe elections and trade agreements, but the most consequential shift in modern finance didn't happen on a battlefield. It happened inside payment systems you've never heard of. Most people assume the US dollar dominates because there's no alternative. That assumption is about to be tested. Because while Washington focused on sanctions as leverage, China focused on something far more strategic, infrastructure. And once you see what really happened, you can't unsee it. Welcome to The Wealth Timeline, where money, power, and history quietly shape the world around us. Today's story isn't about a dramatic collapse or a sudden crisis. It's about a methodical rewiring of global finance that happened while almost no one was watching. In the year 2000, the architecture of global finance looked settled. The US dollar anchored international trade. Cross-border payments flowed through Western banking networks. Settlement systems built in the 1970s still carried trillions in daily transactions. This arrangement seemed not just efficient, but inevitable. What almost no one questioned was a simpler reality. Every major financial pathway ran through systems that one country could control. At the time, this seemed reasonable. What policymakers in Beijing noticed was the vulnerability. The catalyst wasn't Chinese ambition, it was American policy. Throughout the 1990s and 2000s, the United States increasingly used financial access as a geopolitical tool. Sanctions targeted not just governments, but banks, payment networks, and foreign reserves. This approach was effective. Nations facing exclusion from dollar-based systems faced economic paralysis, but effectiveness created a lesson for others. Chinese strategists didn't view sanctions as merely punitive. They viewed them as a revelation about system design. Any economy reliant on foreign-controlled financial infrastructure faced a structural risk that transcended normal market exposure. The Bretton Woods system had been built on an assumption that economic integration would always override political conflict. For decades, that assumption held. It worked, but only under conditions that would not last. China's response was neither confrontational nor ideological. It was infrastructural. Starting in the mid-2000s, Beijing began constructing parallel financial systems, domestic payment platforms independent of Western networks, currency swap agreements with trade partners, settlement mechanisms designed to bypass traditional correspondent banking. Each initiative delivered tangible benefits. Trade friction decreased, transaction costs fell, partner nations gained flexibility, but each success carried an unintended consequence for the existing order. The more international trade settled outside dollar-based rails, the less essential those rails became. What started as redundancy evolved into optionality, and as these alternative systems matured, their momentum became self-reinforcing. The stronger they became, the harder they were to stop. The first structural strain appeared after 2008. The global financial crisis originated in US mortgage markets, not in Beijing, but its aftermath reshaped Chinese strategic thinking. While Western economies focused on immediate stabilization, China accelerated long-term infrastructure development. Warning signs were visible to those watching closely. Trade agreements increasingly settled in local currencies. Bilateral swap lines expanded outside IMF frameworks. The cross-border interbank payment system launched in 2015, offering an alternative to SWIFT. Nothing collapsed. And that was the problem. Because financial systems rarely fail when they're weakest. They fail when alternatives quietly reach maturity. The decisive moment wasn't a crisis. It was a validation. As Western sanctions expanded in scope during the 2010s, targeting Russia, Iran, and other nations, they confirmed China's original concern. Access to reserves could be frozen. Banks could be disconnected from payment networks. Dollar liquidity could be weaponized. From Beijing's perspective, continuing to rely exclusively on Western financial infrastructure was no longer a calculated risk. It was an unacceptable certainty. Chinese policy documents began referencing not timelines, but strategic windows. Not predictions, but preparation horizons. The language shifted from if to when. From this point on, the outcome was no longer optional. This transformation did not eliminate dollar dominance. It eroded its monopoly. The United States retained enormous structural advantages. The deepest capital markets in history, established legal frameworks, and global investor confidence. But power began diffusing. Certain nations gained bargaining leverage they previously lacked. Others gained resilience against external financial pressure. International trade became more modular. No single headline marked the transition. Only cumulative adjustments across thousands of transactions. Agreements and system upgrades. Those who controlled infrastructure gained optionality. Those who relied on assumptions absorbed costs. This is where historical pattern recognition matters, because this dynamic is not unprecedented. Reserve currencies rarely collapse overnight. They are gradually routed around, not because they fail, but because incentives evolve. Sterling's decline as a reserve currency took decades. The process was incremental, not catastrophic. History doesn't repeat events. It repeats incentives. And the incentive shaping financial infrastructure today is not confrontation. It is insulation. Two lessons emerge from this story. First, financial architecture shapes geopolitical power long before political systems react. Second, the most effective strategies are often invisible while they're being executed. Because in the world of wealth and power, history never ends. It just changes hands. If you enjoyed uncovering this hidden chapter of history, make sure to like this video, subscribe to the Wealth Timeline, and turn on the bell icon, because the next story might just change how you see power itself.